Okay, let's jump right into this, because what we're tracking today is honestly one of the most dramatic storylines in modern tech. For the past couple of years, you've probably seen the headlines screaming that the fintech sector has totally collapsed. And, well, they were right. The era of fintech we all knew, it completely fell apart. But here's the absolute wild part. At the exact same time it was dying, it was being reborn. It's coming back with an entirely new body yet wearing the exact same crown. Today's explainer is going to show you exactly how that happened, breaking down a really brilliant analysis by Thorsten.
The core theme we're looking at here is simple, but it's super profound. The king is dead, long live the king. Now that sounds like a total contradiction, right? But as our source points out, it's actually a statement about continuity through a massive rupture. That old individual version of fintech that we all got used to over the last decade, that is genuinely, factually buried. But the institution itself endures through this massive underlying relocation of value. You kind of have to be able to hold both of those truths in your head at once to really grasp what's happening in the market right now.
So let's get into it. Section 1. The death of fintech. A truly brutal reset.
Look, we're not going to sugarcoat this, because the reality of the 2022 to 2024 collapse was absolute destruction for the sector's previous era. Just think about the sheer scale of the drop. Back in 2021, venture capital exit value in the fintech space was sitting at a massive $222 billion. But in the years immediately following, it plummeted to under $30 billion. I mean, valuations didn't just experience a slight dip, they brutally reset. This wasn't just some minor market correction. This was the market aggressively exposing the delusions of the prior era, where simply existing as a financial technology business somehow earned you an automatic premium. Well, that category premium, it absolutely died.
And if you want to know what the literal headstone of this era looks like, it's a number, $15 billion. That is the valuation of Klarna at its 2025 IPO. So what does that matter so much? Because in the private markets back in 2021, Klarna was valued at nearly $46 billion. Now, going public at roughly a third of your peak isn't necessarily a failure of the company itself, but man, it was a massive correction. To put that into perspective, it was the market loudly declaring that it had totally confused cheap capital and pandemic-era user growth with actual durable business value.
Moving right along to Section 2, why the interface failed.
So why did this death actually occur? Let's do a quick clinical diagnosis of the problem, because understanding what broke is really the only way to understand what's being built right now. The companies that struggled the most were essentially just a prettier front end. They had these incredibly slick interfaces, they drove super fast user growth, but they were operating on rented rails using cheap capital. When interest rates completely shocked the system and capital got wildly expensive, investors started asking a very basic but terrifying question. Where are the durable margins? What is literally stopping a traditional bank from just copying this app? And the answer was, well, unfortunately, not much. That thin layer of value just completely collapsed. Now contrast that with the new era of fintech. This is where the rebirth is happening. It's entirely focused on deep infrastructure, machine trust, AI agents, and most importantly, durable margins.
Which brings us to Section 3, the rise of agentic payments, the absolute new frontier.
Here is the massive plot twist. While everyone was completely distracted by the death of the pretty apps, the underlying money was actually moving in a huge way. Global fintech funding didn't disappear. It actually surged 35% to $52.7 billion in 2025. But the shape of that money, it changed entirely. AI-enabled fintechs suddenly captured 23% of all fintech funding in Q3 2025. Get this, 5 of the 10 largest equity deals that entire quarter went to companies with AI right at their core. The market completely stopped paying for a generic fintech label, and instead it started paying a massive premium for fewer, larger, and highly selective bets in this specific new space.
And what exactly is that space? Let's clearly define this buzzy new core concept so we're all on the same page. We're talking about agentic payments. This is the infrastructure built specifically for AI agents to handle financial tasks end-to-end, from the very moment a transaction is initiated all the way to reconciling the whole shebang. This is a category that literally barely even existed a couple of years ago, but early-stage companies building this exact thing drew a massive 80% spike in equity funding in 2025.
Section 4. Big Tech builds the rails.
Now, if you're sitting there thinking this is just a bunch of fringe startup hype, think again. The massive, heavily regulated incumbents are already moving in with incredible force. The sheer volume of institutional buy-in here is staggering. Stripe and OpenAI shipped the Agentic Commerce Protocol, A shopper can now literally complete a purchase right inside ChatGPT, with OpenAI taking a 4% merchant fee. Boom. Visa launched Intelligent Commerce and an agent score, which is essentially issuing credit cards for AI agents with user-set spending caps. Mastercard launched Agent Pay for machines, settling microtransactions at literal machine speed for fractions of a single cent. And Google, teaming up with AWS, Shopify, and a few others, moved the X402 protocol right under the Linux Foundation. Listen, this isn't a sector dying. This is a sector being entirely rebuilt from the payment rails up for a world where the customer initiating the transaction is a piece of software.
And the sheer scale of this new body? $3 to $5 trillion. That is the projected value of agent-driven commerce by 2030. That is enough to reshape the entire global economy. The direction here is absolutely unmistakable. The crown has officially passed to the infrastructure of machine-initiated money movement.
Let's zoom out for a second, because what you're learning right here is a universal framework for tech markets. This exactly mirrors the broader cloud to AI shift. You see the exact same oligopoly plus tail structure, where card networks and Stripe act as the new hyperscalers. You see the commodity trap, where payment processing suddenly reveals a whole new frontier of scarce expertise. You see shifting frontiers, moving away from a focus on just user growth to a hardcore focus on machine trust and credentials. And finally, you see that huge valuation bifurcation. AI-native fintechs are raising capital easily, while regular legacy fintechs get totally squeezed. It's all part of the exact same historical pattern.
But let's act as a speed bump for a second to slow down the hype train. Is this resurrection totally guaranteed? We have to maintain our analytical rigor here and not just blindly buy into the excitement, right?
So, let's dive into Section 5, the honest bear case. Let's look at the risks. We absolutely need a reality check here because there are 3 massive hurdles standing in the way of this transition that we cannot ignore. Step 1, public market hesitation. That IPO surge we thought we'd see in 2025, it fizzled out fast. Giants like Stripe, Plaid, and Revolut all chose to stay private. And as we just saw with Klarna, a private market premium is just an unvalidated bet until the public market actually confirms it. Step 2, unproven economics. Guys, this is a massive land grab right now. Merchants are fighting incredibly hard against the agent layer trying to insert itself as this new 4% toll booth. Even OpenAI stepped back slightly from native checkout to shift purchases toward merchant-controlled experiences. And step 3, regulatory landmines. When an AI agent buys the wrong thing, or worse, gets manipulated, who is actually liable? Europe just saw its very first regulated AI payment via Mastercard and Santander, which is huge, but the rules are being written in real time. Regulation could easily slow this whole thing down just as fast as it could enable it.
Finally, Section 6, where the value relocated.
Let's tie the death, the burial, and this complicated resurrection all together. I want to leave you with this final, really memorable mental model from our source material. Don't ask if fintech is dead or alive. That is simply the wrong question. Ask where the value relocated. Because the value, it didn't vanish. It simply moved away from being a pretty interface on rented rails, and it relocated straight into the infrastructure. It moved from user growth to machine trust. It moved from trying to be a prettier bank to becoming the fundamental toll booth on all agent-initiated commerce. The companies still mourning the old frontier, they're going to keep dying. But the ones building the new rails, they are getting crowned as we speak. So, I leave you with this one thought. As AI agents completely take over the act of buying, who do you think will ultimately control the toll booth of the internet? Thanks so much for joining me on this explainer, and I'll catch you in the next one.